It's been almost 2 decades we've been on this journey to educate, liberate, and help you take action so you may better manage your financial future, achieve peace of mind, and accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you set your goals and guide you along the way to help you achieve them. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. I'm your host, Johnny Dean, with our own Rick the Professor Plum, Chief Financial Planning Officer. Podcast time again. Johnny Dean, Professor Rick Plum, Lucia Capital Group, as that nice guy just introduced us. Guy's got a real velvety vocal tone. Did you notice that, Rick, on that intro? Maybe you didn't hear it. But
I usually close my ears when I listen to it.
That's probably a good idea. We are here once again, managing your financial future, and that's what we do. Manage your future. Try to manage your present as best we can. Give you some sort of, I don't want to say generic topics because it's not, but specific topics you can email us. We're going to get to a couple of emails here coming up in just a bit. But I want to tackle this right away because we had a few questions on this, and I'll just take one email here from Rose. I think it's Rose. Let's see. Do I have a name on here? Oh, yes, Rose. Okay, Rose, somewhere in America. I don't have the location. But anyway, Rose had a question. I'm sure a lot of other people do, and I don't think we've talked about this on the podcast. I know we did a Lucia Capital Group weekly on this, but not on the podcast. So for those who missed it, here you go. Rose says, I was wondering if we will be having a discussion, meaning you guys, a discussion on the COVID-19 RMD distributions rules that have changed and the effect of not taking a required minimum distribution in 2020. So what Rose is asking, of course, is what's different now about RMDs? You know, we had RMD changes at the end of 2019, as you recall, with the Secure Act. And
I think that's part of the confusion.
Yeah, so let's go over some of these, if you would, Professor Plum. First of all, what changed? I know we've talked about this in this podcast, but we'll do it again briefly. Let's talk about what changed with the Secure Act at the end of 2019 first.
Well, the Secure Act last year, this is before the COVID issue, changed the required beginning date for required minimum distributions. In the old days, last year, if you were 70 and a half, at some point during the year, you had a required minimum distribution for that year. So if you turned 70 and a half in 2019, then you had a required minimum distribution for 2019. Then what they did was they changed the rule. And so they said, if you are not going to be 70 and a half in 2019, we're going to give you a little reprieve in that now anybody who has not 70 and a half in 2019, their required minimum distribution date is the year they reach 72. So they deferred the required beginning date for people who were not yet 70 and a half for another year and a half out to age 72. So what if you were required to have a distribution this year? That's where the CARES Act came in. The CARES Act said, we don't care when your required minimum distribution date was. The issue is, do you have one? And if you do, forget about it for 2020.
If you have one, you don't.
Yeah. The CARES Act waived the required minimum distribution for 2020. And for 2020 only. And it doesn't matter how old you were. It doesn't matter if you're a beneficiary of an IRA or the owner of the IRA. If you would have otherwise had a required minimum distribution in 2020, you don't now. And you don't have to claim a coronavirus qualifying event or any of that. It's just there are no required minimum distributions for the year 2020.
Yeah, so even if nothing really changed for you, other than you're wearing a mask outside, but nothing changed for you financially, you weren't affected from your job and all that stuff, it doesn't matter. You will not have. It was just a blanket erasure of the required minimum distributions. Now, was there reasoning?
Now, that doesn't necessarily mean you shouldn't take some money out of your IRA. It just means that you're not required to.
Well, okay, so that was going to go back to my question, which was there reasoning similar to the reasoning they had back in 2009 and 10?
Well, the 2009 and 10, they were just being stupid. But the idea is that they did not want you to have to sell assets when the market was down.
Yeah.
Now, at this point, the market actually is almost back to where it was. We're within 3 or 4%, I think, of the high point. It's recovered nicely. But when they passed the CARES Act, we were in the middle of the downturn. Everything was going crazy. April got worse. They didn't want you to have to sell assets to create a required minimum distribution. And to me, this just goes to show that Congress has absolutely no idea what's happening in the real world. Because the only people that have a choice of when to take their required minimum distribution are people that don't need the cash to live. People that need the cash to live, they're going to take the money whether it's required or not because they have to live.
They're probably taking more.
Yeah, but the people that do not have to take, that have the financial ability to not take the required minimum distribution, well, they don't have to sell anything to take a required. In fact, right now might be a good time, or actually back in March and April would have been a good time to transfer assets from your IRA to your Roth or to your personal account when they were down. Something was worth $100,000 and now it's worth $50,000. Well, it's better to take it out of the IRA, not sell it. I'm not talking about selling it to cash and taking cash out of the IRA. Just take the asset out and pay the tax at the lower value, and then hopefully it recovers. It all happens inside either the Roth or your personal account, and it's no longer part of your IRA. It doesn't return to value in the IRA, which then creates a higher required minimum distribution in the future. Required minimum distributions do not have to come out in cash. So you don't have to sell the asset to be able to take a required minimum distribution. People take in cash because they're spending it in cash.
Yeah.
But like I said, those people need to spend it whether the market's down or the market's up. They're spending it. The people that don't need to take it are the ones that can afford to leave it alone. And those are the ones that right now should be considering looking at where they are, what's going on, and maybe using this pseudo tax holiday in some respects to do Roth conversions. Now, maybe their required minimum distribution was $50,000 and they've only got $20,000 of room in their tax bracket. That makes it easy. You don't have to do the whole 50. Now, in the past and in the years to come, you cannot convert a required minimum distribution to a Roth. So I'm not talking about that. But this year, there is no required minimum distribution. So we have Roth conversion options again.
Yeah, it gives you a little bit of an opportunity to take what would have been perhaps your required minimum distribution amount and convert it over, if that indeed is something that fits into your particular situation. Now, we did the podcast I'm sure it was a podcast in January where we talked about and this, of course, was before any of this happened, right? None of this COVID stuff. So we had talked about the benefits of taking a required minimum distribution early in the year, say in January, which is, I think, what we were saying. If you want to take it, maybe take it for various reasons in January. We listed the reasons. Now, what if somebody did take a required minimum distribution back then and then decides now, well, gee, I don't think that was such a good idea for whatever reason? What happens to those people who had already taken it?
Well, there is a window. They extended the 60-day window all the way up to July 15th to redeposit a distribution from an IRA and avoid tax. So you have to be eligible to do the rollover. You can't have done one within 12 months prior. It's only good on one distribution. So if you've taken multiple distributions from your IRAs, you can't put them all back in. You can only take and put one of them back in. But you have up to July 15th to redeposit money into an IRA that you took out earlier in the year and avoid the taxation for this year. They did extend that to July 15th. But again, it's only for one distribution because it's an extension of the traditional rollover rules, the 60-day rollover rules. And you're only allowed to do one rollover in a 12-month period of time. Now, and so you're still only allowed to do one rollover in a 12-month period of time. You just have a little bit more time to be able to put the money back in.
Now, for people who had turned age 70 and a half last year, 2019, and they put it off. They said, well, I'm allowed on my first required minimum distribution, I'm allowed to wait till the following, second quarter, the April of the following year to take my first RMD, and I'll have to take it.
You have to take it in the first quarter.
But you have to take it before April 1st. And they waited, and then they said, and then obviously all this stuff came out. How does that affect somebody who was waiting to take their required minimum distribution before April 1st of 2020?
It waived that distribution as well.
So even though it was for 2019, what we're saying is that they didn't that additional their 2019 RMD was waived in that instance.
Right. If your very first required minimum distribution was 2019, that was your first distribution year. Your first RMD can be postponed until April 1st of the following year. Well, if you actually did that and that happened in 2020, you can ignore that one too. It's waived. Now, you still have one for 2021 coming up, so you can't waive anymore unless Congress does that again.
Sure, but in essence, I mean, I would have had to, let's say it happened to me, I turned 70 and a half in 2019, and I would have had to take one in the first quarter, and then the rest of it before the end of 2020. So you're saying that I could skip my 2019 and 2020 RMDs?
Yes, if you had postponed the 2019 to the first quarter, yes.
And the way the law is written, as you just said, Professor Plum, the way it is currently just for all of 2020, I guess.
Right, for any required minimum distribution that was required to be taken out sometime between January 1st and December 31st, 2020, you can ignore those.
Well, there you go. Now, were there any other provisions for RMDs? I know we talked about putting it back into the IRA. What about 401ks and all that? Because obviously that's a salary deferral program. But how does that work with 401ks?
It would be there are no required minimum distributions from any required retirement plan. 403b, 401k, profit sharing plan, whatever the case may be, there are no required minimum distributions for 2020.
Yeah, but I'm saying if somebody did it already in a 401k earlier in the year, and they say, well, gee, I shouldn't have done it, do I pay it back the 401k? Is that how that works?
Most likely they'd pay it back to an IRA.
Okay, all right. So, but not back to the 401k.
I believe you can, but people would just go to an IRA with it anyway.
And I know we've talked too about loans and all that. I don't want to get too heavily into that because I have a couple other things I want to talk about here. But loans and a 401k, some of the penalties that, taking money out of a 401k. Can we just go over those very quickly for the next 60 seconds or so?
Well, if you are a current participant with a 401k and you want to take money, you need access to money, and you have a COVID-related issue. You are diagnosed. Your spouse is diagnosed. You have reduction of hours. You have a financial hardship because of the COVID type things, and you can certify that you are that way. You would self-certify it. You can do what's a COVID hardship distribution. Now, hardship distributions from 401ks have been around for a long time, but with hardship distributions, you're not allowed to repay it. You're not allowed to put the money back into an IRA. They're not rollable, and they still have a penalty associated with them if you take it out before you turn 59 and a half. If it's a COVID-related distribution, you can take out up to $100,000 from a retirement plan before age 59 and a half and not have to pay a penalty. And it can be rolled into an IRA or back into the plan within the next 3 years. So instead of a 60-day rollover, which wasn't available for hardships, but just for general distributions, you've got a 3-year period. It gets a little complicated when it comes to taxes and repaying it if you don't repay it right away, but that's what happened. The other side of it is if you belong to a 401k and that 401k allows loans, in the past, you could borrow up to half of your vested balance, 50% of your vested balance, with a maximum of $50,000. So to get a $50,000 loan, you'd have to have a $100,000 vested balance in the 401k or retirement plan. If you are eligible for a COVID-related distribution, that number goes to 100% of $100,000. So if I have $100,000, in the old days I could only borrow 50. Now I can borrow all 100, and I have basically 6 years to pay it back instead of 5.
Yeah, and you have 6 years because you don't have to start paying it back this year. Year one will start in 2021, which gives you 5.5 years, or however you want to look at that. Interesting stuff. Now, if you do take a distribution, okay, two things. First of all, you said it is self-certifying, meaning that they're going to take your word for it on this, that it's a COVID-related distribution of some kind, right?
Right.
Okay. So there's...
You have to answer the questions. Yes, I have been affected in such and such a way.
I don't know how they'll ever come back and make you verify it, but whatever. this means that the penalty is waived, not the taxes. And I want to make sure that
if you take a distribution, the taxes are still there. Now, the advantage with the COVID-related distribution, whether it came from an IRA or retirement plan, is that you get to spread the taxation over 3 years, 2020, 21, and 22. And so if I took a $90,000 distribution, I did that for easy math, I would show $30,000, 1/3 of that distribution, as a taxable event in 2020, a third in 2021, and a third in 2022. Now, if I repay some of that distribution or all of that distribution, then I adjust how much is outstanding and I adjust my taxes for each year. So if I don't do anything in 2020 or 2021, but in 2022, I pay back the entire 90, which I'm allowed to do because I've got 3 years to pay it back. Well, I paid taxes on $30,000 in 2020. I paid taxes on $30,000 in 2021. What I would do in 2022 is go back and amend my earlier two returns and recoup the tax money that I paid in those years.
I don't know how many people will do that, but that is an important point to make.
Well, it depends. I mean, if I know some people who were looking to buy houses and they took money out figuring that they could then, come up with the money. They couldn't do it in 60 days, but they do believe they can come up with the money in 3 years.
Yeah, I suppose that's true. But just so you know, this is a penalty waiver, not a tax waiver. I just think there are going to be people who believe that, I can take it out tax free, like a Roth, like a Roth IRA. No,
nope, not tax free.
Just gets you out of the penalty. There are other ways. There in the old rules. I don't want to say old rules. This is again only for 2020. This should, I believe, end unless they change the law as soon as January 1st, 2021 hits. Correct?
Correct.
Okay, so we did have that question from Rose, and I know we've spent a little more time on it than I thought, but for people who really do need this, people seem to want to access cash, and they want to do so without penalty. This may be one way to do it. So anyway, Rose, I hope that answers your question. Let's see. I have a buckets question here, Professor. I guess we can do it very quickly. This is from Rick in Pompano Beach, Florida. Brain Trust, need your help. I'm a retired Fed. I assume this means federal employee. Right now, we're living off my pension and my wife's salary. She retires at coming up on the first of the month. Then we start hitting the 401ks. I have years 1 through 5 retirement income in a money market, also a rainy day fund, $110,000 in a money market. The rest of the portfolio is a 65-35 mix. Have not set up buckets 2 and 3 yet. Can I move my rainy day and part of bucket 1 into a 6-month brokered CD at 1.5% instead of the money market at 0.000001%? I'm open to more suggestions. Would like to get a little more bang. Thanks. That was Rick.
I would want to know what the penalty would be to get some money out of it in the next 6 months. Did he say when his wife was retiring?
Well, she said at the first of the month, so it's coming up.
Okay, so he may want to keep the next 5 months or 6 months of spending distribution not in the CD, because that way he doesn't have to sell it early, and then put the rest of it in the 6-month CD so that 6 months from now he's got the money available to him. But any money that he might need between now and 6 months, he keeps in a money market account. I don't know where they're all at. But I know there are FDIC insured online money market accounts that pay better than 1%. And there's no penalty for taking the money out early. So maybe you keep 6 months worth of money in there and you put the other in the 6-month CD.
Yeah, we talk a lot about, when we talk buckets, we talk about value averaging and things that you might want to do between buckets 2 and 3, moving money here and there. But really, you can make adjustments to bucket number 1. And oftentimes we do sort of bucketizing the bucket with bucket number 1 to do exactly what Rick is looking to do, which is maybe get a little bit more bang from a very small buck.
Right, and I mean, you could put the 6 months in the online account. You could put the next 2.5 years in the CD, and then the money that you don't need for 3 years, because he was talking about years 1 through 5 or 1 through 6, put it into an account that pays 2.15%. A 3-year fixed annuity or something.
Yeah, exactly. So there are ways to do this. There are ways to bucketize the buckets, and that's another discussion which we may have. We're out of time. I'm told that this is the last show of our season 2. Season 2 already? of this podcast? Well, they're divided up into 12 episode seasons. Which is, see, we could be in season 25 and have only, done this for a couple of years. But anyway, so we will be back if you're listening live and taking these or doing these weekly and listening to them as they come out. I'm told there will be a couple of weeks here, a few weeks over the summer where we won't have them, but we will be returning with more for our third season, if you want to put it that way. If you need to get in touch with the Brain Trust, you want to talk with Professor Rick Plum about all this stuff, we're here anyway. We're always here. You can give us a call at 800-644-1150. That's the number that at Lucia Capital Group, 800-644-1150. Talk to your advisor. Very important. Talk to your advisor about things we talked about today, which have to do with required minimum distributions. Do you waive it? Do you do a Roth conversion? Is this a good time? It's a wonderful time to start talking to your advisor to see exactly what may work for you with the new laws. So talk to them about that. Talk to them about things you may want to do with your 401k or your IRAs, all that stuff that we talked about today. Give them a call, 800-644-1150, or go online, luciacap.com. Professor Plum, it's been fun for me.
Me too.
Okay, just checking. I just have to get an affirmation. For Professor Rick Plum, certified financial planner professional, I may add. I'm Johnny Dean. We thank you very much for listening to the podcast, and we will talk to you again real soon. Take care.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by Lucia Capital Group, will be either suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Fixed indexed annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Investors should speak with a financial professional about the contract's features, benefits, risks, and fees, and whether the contract is appropriate for the investor based upon his or her financial situation and objectives. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. The investment professionals are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. Lucia Securities, LLC was acquired by LPL Financial August 2020. The investment professionals of Lucia Securities, LLC are now affiliated with LPL Financial and are conducting business using the name Lucia Capital.